Assalamualaikum warahmatullahi wabarakatuh. My name is Aniqah Rushda binti Muhammad Zahir, and today I would like to answer the question for number one. Question number one refer to difference between audit risk and business risk. Okay, let's take a look for the first one, which is audit risk. Audit risk is referred to as the risk that the financial statements are materially incorrect and the multifunctioning and ineffectiveness of internal control system are overlooked while the auditors form an opinion stating that the financial reports are free of any material error and a sound internal control system is in place. Okay, for the business risk is the uncertainty of obtaining in profits or possibility of loss and the occurrence of any event that could pose a risk due to unforeseen event which will negatively affect the business. Next, I will explain the difference between audit risk and business risk in terms of review of risk. Alright, for the audit risk is reviewed at the time of preparing audit reports, while for the business risk should be reviewed continuously due to its recurring nature. Then, for the second one is for the term of responsible personnel for risk identification, audit risk, internal and external auditors are responsible for identifying the audit risk, and for the business risk should be identified by the management only. In conclusion, the difference between audit risk and business risk mainly depends on the nature of the respective risk. Audit risk arises from the inefficiency of internal and external process, while business risk can arise due to the number of reasons relating to strategic, financial, operational, and reputational or any other industry-specific aspect. Both these risks can have several damaging effects on a company. Thus, sound risk management practices should be in the place to identify and mitigate the risk in a timely manner. Then, we move to the next question, which is question 2. The question is justify how the auditor determine the relationship between audit risk and the engagement risk. Okay, in audit of financial statement, audit risk is the risk that the auditor expresses and inappropriate audit opinion when the financial statements are materially misstated. For the examples, the financial statements are not presented fairly in conformity with the applicable financial reporting frameworks. And for the engagement risk is the overall risk associated with an audit engagement. It can include a loss of reputation from being associated with a particular client and the financial losses from the association. Engagement risk tends to increase when a client in a weak financial condition, and especially when it will likely require an additional financing in order to survive. In this situation, the client is more likely to go bankrupt, in which case investors and creditors will be more likely to drag the auditor into any subsequent litigations. In the simple terms, audit risk is the risk that an auditor will issue an unqualified opinion on materially misstated financial statements, while for the engagement risk is related to the auditor's exposure to financial loss and damage to his or her professional reputation.
Auditors must decide the appropriate audit risk for an audit, preferably during audit planning. First, auditors decide engagement risk and then use engagement risk to modify audit risk. The factors contribute to audit risk are the degree to which external users rely on the financial statement. When external users place significant reliance on financial statement, it is appropriate to decrease acceptable audit risk. When the statements are heavily relied on, a great social harm can result in if significant misstatement remains undetected in the financial statement. Besides that, the likelihood that a client will have a financial difficulties after the audit report is issued. If a client suffers significant loss, auditors face a greater chance of being required to defend the quality of the audit than if the client were under no financial strain. Finally, the auditor's evaluation of management's integrity. If a client has questionable integrity, the auditor is likely to assess a lower acceptable audit risk. Thank you.
My name is Saidatul Shaurah, and I will be presenting the answers for question number 4, which is how the materiality influences in assessing the audit risk. So materiality comes into effect when auditors analyze the quantitative and qualitative characteristics of the type under considerations. When it comes to assessing materiality, it is often better for auditors to do so when they look at the financial statements as a whole. However, with regards to the complications introduced in a group audit, it is challenging when looking at a group audit that has business units all over the world. They have to assess materiality for the consolidated financial statements. But even the tolerable misstatements that auditor is setting for each individual component, where they will be gathering evidence. This is due to the fact that it influences an error that may occur in one area but that is not material. But when the same error occurs in multiple locations, it might aggregate to a material error. As a result, the auditor must understand how low the risk should be while balancing how efficiently they must work to ensure they are addressing the aggregation risk of errors in the material. The auditors also have to think about each individual location's quantitative and qualitative characteristics that led them to lower the tolerable misstatement. So materiality has been defined as one of the most challenging subtle judgments one needs to make. The quantitative features works well when the company is profitable on a consistent basis and the benchmarks are met. It works with a single entity. However, as difficulties arise, auditors are forced to make judgments based on limited quantitative data underlying the financial statements. For example, how can auditors assign a $1 metric in a group audit or in a loss-making company where the auditors no longer have net profits to look at? How to conduct how to conduct the evaluation. So one of the complications when assessing materiality is when we establish the judgment early on in the financial year. This is because we need to use that materiality measurements to scope our audit, which locations we are going and which accounts we have to address, and so forth. The figure is based on a projection that management has, which might be revenue or profits. Aside from assess what appropriate materiality number is, that they have to rely on the projection, it also involves assessing management's effective of setting projections and how accurate the managements have been in the past. So as auditors, we must ensure that the audit committee and management team understand the risk that occurs based on what is happening in their own business in order to plan and work on risk assessments. As a result of the knock-on consequences, auditors must re-evaluate materiality such as risk assessment throughout the audit.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Izzati Latiff, and I will be the next presenter to explain the types of audit materiality. So before we go straight to the point, I will explain a little bit definition of audit materiality. So audit materiality is an important aspect of auditing in which the company's misstatement are regarded material if they are likely to have a reasonable impact on the economic decision of the company's financial statements users. So when assessing materiality, both quantitative and qualitative characteristics are taken into the account. So when comparing the qualitative and quantitative approaches, the qualitative approach is often more difficult to measure. So we can see there's a type of audit materiality. So one is overall materiality, overall performance materiality, and last is specific materiality. So overall materiality is the level in the financial statements of the company that represents the significance level in the financial statements of the company that can influence the decision making of the users of the financial statement of the company as whole or as judged by company's auditor. So next is overall performance materiality. The materiality level evaluated by the company's auditor is known as overall performance materiality. So it could be the amount that is smaller than materiality's overall level. So this materiality level is lower than the overall materiality level to account for the possibility of multiple minor errors or omissions that the auditor missed. So they are, however, substantial when aggregate in whole, reducing the likelihood that the total number of tiny misstatements suppresses the overall materiality limit. So last but not least is specific materiality. The materiality that level selected to discover probably misstatements if is referred to a specific materiality. So this may exist in various regions of the organization. For specific types of transaction and for account balance that may influence the economic decision of users of the company's financial statement. Okay, so now we can see example of audit materiality. So consider to this case of XYZ company which received an 432,500 ringgit loan from the bank. So the bank granted the loan but only on the condition that the company's current ratio not fall below 1.0. So in this regard, the company agreed and signed an agreement with the bank. So now when completing the audit, the company's auditor became aware of this agreement. But at the moment, the company's current ratio is only slightly higher than 1.0. So for the company's auditors, a minor mistake of 12,975 ringgit can be significant. It may result in breach of the company's and the bank's agreement. So the company's current ratio would likewise fall below 1.0 as a result of the 12,975 ringgit misrepresentation. So as a result of this, would be part of the audit materiality because it might result in a violation of the agreement. So it has the potential to have a reasonable impact on the economic decision made by users of the company's financial statements. Thank you.
So the last question is elaborate the impact of risk and materiality on audit quality. So audit risk and materiality affect the application of generally accepted auditing standards, especially the standards of fieldwork and reporting, and are implicit in the auditor's standard report. Audit risk and materiality, among other matters, need to be considered together in determining the nature, timing, and extent of auditing procedures, and in evaluating the results of those procedures. Audit risk is the risk that the auditor may unknowingly fail to appropriately modify his opinion on financial statements that are materially misstated. The concept of materiality recognizes that some matters, either individually individually or in the aggregate are important for fair presentation of financial statements in conformity with generally accepted accounting principles. The auditor should consider audit risk materiality both in planning the audit and designing auditing procedures and evaluating whether the financial statements taken as a whole are presented fairly in conformity with generally accepted accounting principles. The auditor should consider audit risk and materiality in the first circumstance to obtain sufficient competent evidential matter on which to properly evaluate the financial statements in the second circumstance. In evaluating whether the financial statements are presented fairly in conformity with generally accepted accounting principles, the auditor should aggregate errors that the entity has not corrected in a way that enables the auditor to consider whether, in relation to individual amounts, subtotals, or totals in the financial statements, they materially misstate the financial statements taken as a whole. Qualitative considerations also influence an auditor in reaching a conclusion as to whether errors are material. It is also important to note that even if firms alight on the same figure for materiality, the nature, timing, and extent of audit work performed will vary depending on other decisions made regarding the audit approach. The decisions include, but are not limited to, the extent of reliance on the testing of operating effectiveness of control and methodology underlying the calculation of sample sizes.